and and that we would ideally like to have these reports by September so that we can do our forecasting, better forecasting into the new year, which will really help the board immensely. Um, Owner input and professionals. So over the last 2 to 3 weeks, I sat down with a couple of owners and I had meetings with them to go over, and these are professional people who have some sort of education and that work in these types of processes. And from that, we gleaned 4 key points from the conversation. There were many more, but we wanted to get the ones that were the most significant. We're still back on the page before, if you can. Oh, owner input and professionals. You didn't get that page? It was in that deck.
It's a page after, I think.
Yeah, here.
Okay. So we can, what we got from that was that it's in the opinion of the people that I spoke to, the owners in the building, that we need to have engineers prepare the reports. The A lot of the issues that we have right now with the forecasting is that the last two updates could be even more than that, or updates done by reserve companies instead of sending the engineers in to do the actual observation or scoping of the different processes. The really good suggestion was that we consult with the Playa del Mar's engineer on the information sharing. By example, they're doing their waterproofing project right now. Now, this is just one of their projects. And the thought was that if we could have their engineer talk to our engineer, that we could share ideas so that our costing and things that might show up in the future that we don't know about right now would better guide us. The third best thing that came out of this was that we should have a ratified process by which the board could follow so that the reporting process becomes consistent. So, and what was meant by that is that there hasn't been a guideline for as the boards change. And so you get new board members every year. New board members don't understand what a SEERS and a non-SEERS is, how they were prepared before, and really what the effect of that has been. However, that process of ratifying a process won't come until the end of what we choose to be a process. And then I think everybody agreed to engage our PDS management engineer to work with the professionals as they come in. He has prepared a book of continued maintenance items. I believe it's over 170 items. He's got that available, but he's going to be able to take them around, show them things that he thinks might be issues, and get them into the inner workings of the building. Next slide where it says steps. Yeah. So there is a process, and it can, to decide which one you want to use, we have to decide where we're at in this process. We are permitted to use engineers by state law or to use reserve study businesses. When you have a building like ours that is 50 years old and is more than 3 stories high, they do tend to, when you read a lot about it and what other people say from the state of Florida, that people tend to rely more on engineers than they do reserve study people. Reserve study people can come in, and if they have engineers with their businesses, they can have their engineers come into the building, but they only do a cursory look at the building. If they see a problem, then we have to bring another engineer in, which causes more expense. So it's, we're going to be looking at all the quotes. Right now we have 6 names, 3 on the engineer side and 3 on the reserve study side. And I just wanted to make a note. that our reserve studies now were done by the Association Reserve Company, and as we know, they haven't been reliable. And so I just want to make that caution. You're going to see them as one of the 3 on our Association Reserve list, and we'll discuss them later. Next, names of recommended partners. So the 3 engineers, the first one that pops up is Epic. Epic is an engineering company that we hired as a board 2.5 years ago. They came in and quoted what they would do for upcoming projects along with Falcon. And M2E was not one of those that bid at the time. At the time, the board chose Epic Forensics in engineering to do our risers and the future on the waterproofing project. On the waterproofing project, they did a preliminary soft look in the garage and underneath where the balconies are to see what kind of issues we would have. It wasn't quite a forensic look, but it was, something to kind of give us an idea about how that we can't hold the project up as much as we might want to hold the project up. But they're already working in the building, and so that was just one item. The quote for doing the Sears and the non-Sears reports for us was $15,500. And if we want a traditional reserve study, it would be $9,700. But to do both the traditional and the Sears and non-Sears, it would be $15,500. And then Falcon and M2E have not gotten their quotes to us yet. We're expecting those and their paperwork to see what their scope of work would be. So that will be continued. Reserve study companies. J.R. Fraser came in with a quote of $10,800 for both Sears, non-Sears, and traditional reserve study. And they gave us, they were the only company that gave us recommendations of who they've used before in the area, and they were more in depth about what they would do. Sedgwick gave us a quote, again, for the same items for $12,645, and Association Reserves gave us $8,800 with a site visit, but not an engineer. So that's where we're at right now with these, and it's just a beginning look at for us to talk about. The next steps. Once everything is, we have all your bids, and we're going to present and review 3 bids at the next F&I committee meeting. So we're going to try to narrow them down to 3 and then decide on the approach to take. That is a light report versus a full report. Therein is the difference in a lot of money for us. So, and the way I look at it is like Association Reserves is a light report versus an in-depth report. Then we select a vendor that we would like to recommend to the board. And then if we can get that all passed, then we can have them come in, do the report, and hopefully, fingers crossed, get it done by September. That's the end of my report.
Barbara, I thought I saw a couple of comments. One is our budget for this activity this year is 8,800. And Barbara, I thought I saw in one of the quotes that the turnaround time could be 4 to 5 weeks. Is that valid or accurate? Is that what you're saying?
It just depends. If that, I don't know. Scott and I initially talked about this, and when they come in and they look at the building, that's the longest part, is getting the report back, not getting them out here. So we haven't set with these companies, we haven't set our timelines with them. And so we have to narrow that down. I think.
So we'll follow up on that during the month and then be ready to have a good discussion with the other members.
Right.
At the next meeting and really be in a position to decide on this going forward.
Right.
Decide on the process going forward.
Right.
Can we get maybe sample reports from them ahead of time just to see what they look like, just the format?
I received one sample from Frazier.
Yep.
I did not, Epic gave us an addendum to their current contract. So, which made sense to me because we already have them as an engineering company working for us.
Okay.
So, we can probably get
We
Ray to
can
send
ask.
one. And yeah, and
I mean, it should look pretty much the same with 30-year funding requirements and all
Right.
that, and so
they
it
set
should
it up
be-
a little different in how, they do their forecasting, I think.
Okay.
And I think the engineering companies, I'd like to see how they do theirs
Yes.
versus the association reserve,
Exactly. Yes.
because they will be different, I think. And although they're going to get to the same point, engineering companies, their job and their licensing makes them responsible for that forensic look at the building. Where when you have an association reserve company, they just do
Use
the peripheral.
averages, general.
They come in, they
Yeah.
kind of kick the tires and
Yeah.
kind of look around, and then they leave. So J.R. Fraser, when they sent us the quote, they were the most complete. I like that because I know when I do things like that, it has to be a complete picture of who you are. So I would like to have that with most of the companies. So if I can get with Scott, we can work on that.
And how much work are we planning to do to help them with this? Because if we don't give them, well, here's what we think we're going to do this year and next year, and we've already done some HVAC, and we think we're going to, if we don't have much input, we're going to get something that's not as.
This is what will happen.
They're gonna ask us, they're gonna compile their list of components, and they're gonna ask us, do we know when the last time it was replaced was? If you do, can we have a copy of the contract?
Okay,
Yeah.
so they go through all that, and
Right.
you have quotes, because I mean, the big projects coming up, if we have quotes like the risers and
correct.
because I mean, those are big numbers, and if we're up $1 million, then the whole thing is,
And that's the whole point. We're trying to get just the
as
key
close as
people
yeah.
to talk to these companies, the people
Yes.
that know. So that would be
Yes.
Rodney and that would be Scott. And we know that we have these quotes already in the works, so they would have those. They also will know how much money we have,
Right.
and then they have to tell us how much we really need.
Right, and it doesn't prevent meetings, so like
Right.
the board getting together and thinking, like there's like, we have to do this kind of project, and we would like to do this kind of
I
other
think
project.
a representative or two from the board would be great, so that we don't have, there's no way for us to have a meeting, if we have more than 3.
But not so much communicating with them, but as a group, kind of like be on the same page of, this is what we're seeing in the next 5 years. These are the big projects. This is the other stuff, to kind of come in with, people pretty much on the same page.
And I think that will come from what we get, because right now, we're working off, I know, from the sheet that we had all the years of life, all the things are at 0
Right.
years of life, and that's what we were
Right.
focusing on.
Okay.
And this was 2.5 years ago. I was focused only on those zeros. And then unfortunately, like the cooling towers, they fell right into, our, oh my gosh, we have to do this.
Yeah.
And and that could have been a number that was offline, or off or figured wrong.
Sure.
They met going back into the.
Sorry, Barbara, just
Yes.
for a matter of time, because Tim Renfro is going to come in, and I want to give Katina some time as well before he comes in at 3:30.
Sure.
So just wrap it up, and if there's any other questions, we'll deal with this either by email or what have you. The point was we want to get the process going.
So it's happening.
Barbara's come up with a great plan. She's done a lot of good work. And we got something to work with, our roadmap, and we're going to follow that. And at the next meeting, and between now and the next meeting, we'll have other meetings to discuss and validate, and who should be reviewing this, and so on and so forth. So
It'll be a
that's
process.
that's how Barbara and I saw it. Any concluding comments? Thank you so much, Barbara. That was great.
You're welcome. Thanks.
So just before I hand it over to Katina, we've had the request from, I think it was at the last Finance and Insurance Committee meeting to have a workshop with the board. And, to do that, we're very much open to it, but we have to have discussions with the board to find out what their expectations are as well. So we just can't start building a workshop. And then when you dig down a bit deeper, had some many of us have had discussions with board members, and it's like, well, we're hearing a lot of things, we're not sure of this, and what have you. And it all reverted around to, our projects, our activities, the building. And so Sandra and Katina stepped up and said, hey, let's start looking or putting on paper what we know. So we've got a lot of information, maybe not all of it, but a lot of information in different spots. And so they took the lead, and Katina, I think you took the lead on that, and leave you 10 minutes or so just to recap what you've done, what you've seen, and more importantly, what do we have to do next?
Yep. Can you pull it up?
Yep.
Okay. So what I did the last couple weeks, I went through the reserve study, which is actually not as bad as we make it sound. And within 0 to 3 years, I mean, you can call that guesstimate. You can't time it to the day, then nobody will. There's not going to be any. But I think it's a pretty good representation of the projects that need to be done and the cost at the time they did it, the cost estimates. And if we look at what we've done already, they're not that far off. So anyway, I looked at this is my assumptions that I made. I used the estimates from the study. I looked owner's contribution, because what I did is I rolled forward the reserves. So I used the owner's contributions as we have them this year and next year. And I assumed in 27, they will continue to be the same as 26 because we need the money. Interest rate, I use about 3%, similar to 26 budget. And then the project calculations for the time being, I put the spending at least for next couple years, the year we start. Because in order to do a roll forward study and see what the reserves are, I made that assumption. I know Heskey has done a month by month assumption, and I looked at his basis, but for the current projects we have, the word is we're going to be finished by October. So I figured let's put them in this year. That's my assumptions. So 26 reserve summary. We have at the beginning of the year in 26, total we have about 10 million reserve, 5.4 Sears, 1.67 non-Sears, and the 2.9 special assessments. Interest rate, fine, owner's contribution, we're contributing about $1 million, almost $2 million to the reserves on an annual basis. And the projects we're going to have in 26 right now look to be about $4.2 million. And as you can see, both the Sears and the non-Sears reserve are still well-funded. And special assessments reserve, we're going to have about $800,000 overage after those projects are completed, which Heskey already had told us in the last finance committee. Let's go to the details. Okay, so the projects we have identified for the Sears, alarm system, water sprinklers, the BDA, and the doors. The doors, I did not see them approved anywhere, but I know that we're spending money on the doors, so I put it in. So about $1.4 million projects for the Sears, and in the non-Sears projects, 100,000 budget for the study on the cooling tower. We spend money already. These are what we have are listed. Carpet. I took the items
from the non-Sears reserve. And I know there's been discussion, do we replace the carpeting when we're doing all the Sears projects? So I figured, let's throw it in there. Now they have fitness equipment. I knew we replaced the fitness
Just in
equipment.
one gym.
Huh?
Just in one gym.
Oh, the other one looks.
The north gym did not get changed, just the south gym.
Anyway, there's 20,000 in
It
for
was-
fitness
it's a little bit over
equipment.
25 for the south.
Well, there's 20.
Yeah.
In the budget.
Right.
And furniture, there was nothing in the Sears budget in the non-Sears for furniture until 2 years from now. But I know we spent about 23,000 on furniture already, so I put it in there. So these are the projects that I know of that are going to be taken care of this year.
Next slide.
Yep, 27. I also did a summary, and I could have taken it out to 28, but we're going to do a new reserve and a new study. So for 20, this is the special assessment. We don't need to go. 28, hold on, let's move on. Okay, so 28 is, no, this is my special assessment. Move on, yeah. Okay, 28. All right, and here's where the interesting things come in. 28, if we look at it based on today's, the study we have, it looks that we're going to be running out of money on the non-Sears reserve if we start the cooling towers. And again, no decision made on the special assessments, so we left them alone. And it looks that our reserves are going to drop from 8 million down to 6 million. Mm-hmm. Let's go through the projects I put in here that I found. Very simple. The risers, and which is the only Sears project that we have in the study for next year. The water proofing project is not, it's not scheduled till 28. And then on the non-Sears, also there's the cooling towers, and I saw 3 quotations for those 2 things in the website, and they are, were minimum 2 million short there, maximum maybe 3 to 4 million. The quotations I've seen is from 4.8 million to like 6.5 million. So, and honestly, there's not many things we can push back. I mean, if we look at the non-Sears projects, we can make a decision on fitness, remodeling equipment, exterior lights, pool filter replacement. But there's not much big projects to save money on. We definitely will have to figure out how we can fund the cooling tower. We do have HVAC. I've seen that we are doing certain replacements, but most of it seems that it's coming in 27 with the risers.
It makes sense.
Next page. Oh, did you get my last page? I sent you. No, okay. I had a page that said my observations and recommendations. I think on an annual basis, as we do the budget, we should also identify officially what projects are we going to work on for the next year. That list, similar to the budget, should go to the board for the annual board meeting, and the board should approve the budget, the projects that we'll be working on. Then I think on a monthly basis, whatever we spend, we can easily update. I asked Scott to give me the general ledger for Sears and non-Sears. We can update the spending on those projects as we did for the special assessment, and track where we are, and also update the cash flow on the reserves. We should not be charging anything to the reserves that is not part of the projects. And if a project comes up that's not approved by the board, I think we need to take it to the board, officially approve, and then start tracking it as part of the projects. I know projects will take more than a year, and that we can have a track of those projects, and as they finish, we close them and continue on. So those were my observations, and have it totally visible in the portal. Also, I have recommendations. We should move history out of the portal, or call it history, and just have the current year and the prior year. So that way it's easy to find the information for the owners. But I think the more visibility we give to the board and to the owners of all these projects, the better off they will be informed, and the easier it will be to get approvals to get these things done.
Well, Katina, this is very good. And your recommendation is spot on regarding when we put together our operating budget, we should be putting together a capital budget or a project budget,
exactly,
and get that approved at the same time. And
Yep.
that really is the guideline for the coming year or years to come in the case of capital projects. So,
and that will also give us the information to say what should be our assessments on an annual basis for Sears and non-Sears.
Well, the assessments come from pretty much from the reserve study. So we should compare the capital budget against the reserve study. Because I mean, that's our budget, that becomes our budget, the reserve study. So if you're not in line, then.
Right.
But
exactly.
they weren't that far. I mean, I went through item by item. They're not that far off.
Where we go off that report would be the cooling towers and the waterproofing.
Yeah, the waterproofing is the key, because
Totally
that one, could be huge, and right?
And that's true. And the engineering should be higher as well.
But also with the waterproofing, yes, part of it would have to be basic when you waterproof, and then you have everything else. It's not, I'm sure there's going to be discussion as what kind of waterproofing are we doing? What can we save that we have? And what do we get rid of because they're troublesome?
Right. So just one thing, Katina, I noticed that Heskey updated his monthly cash flow statement. I thought I saw a couple of items in there, nothing significant, that are not in your presentation. Maybe you can just have a look at that or work with Heskey to consolidate that so that
I also went through Heskey's worksheet. I couldn't figure out how to pull it up on a PowerPoint, but I went through Heskey's worksheet, and I again updated everything on a monthly basis. So I have, and I can send it back out to you. And I'll be happy to do this on a monthly basis.
Well, thank you for that, because
rolled it forward all the way to March, and we can do it on a monthly basis going forward.
Yeah, I think that's a great idea, because you know what? It's these studies are not point in time. They have to be updated on a regular basis. Now, as a monthly, quarterly, or what have you. But if we track it monthly, because at the end of the day, we're spending more money on projects and capital projects than we are on operating expenses.
Totally.
So,
and we're spending a lot of money on EPIC and all the studies. We've already spent over $100,000 on the risers. So I think, I think that's where the money is. It's not on the cleaning service. So,
Well, again, good work, Katina. I think we have a baseline now and we can update it and review it. And thanks for that, Barbara. Thanks for your inputs and very good stuff. And you know what? I'm really happy because we're the finance committee, the finance and insurance committee is collaborating. And we've had several calls and emails outside of these meetings to review information. And I think we're coming together and everybody's participating in a very significant way. And for that, I thank you.
and if we can take Heskey's worksheet and make it a shared file, and then we can update, I can update it on a monthly basis and everybody has access to it. But so.
Okay, good stuff.
Very
Thank
good.
you. And with that, Tim and Meredith are here. So thanks for joining us. And you're next on the agenda.
Do you want us?
Yeah.
We can move around.
Can you? This good?
Yeah, I'm gonna sit over here.
I'll sit up.
Okay, I'll sit here. Meredith, you sit there. And she emailed you a copy of, if you had a chance to, if not, I can hand you a hard copy.
Okay.
Hi guys.
Hi,
You,
good to see you. Good to see you guys.
summary.
If you want me to pull it up on the screen, I gotta run in the office. Real.
That's up to you guys. He can pull up this premium summary on the screen where you guys can see it.
Yeah, that'd be good.
Okay, yes. So I mean, while he's doing that, I mean, I think we have very good news. I mean, we are looking at the.
Well, you had good news 3 weeks ago, so I hope it's even better.
Well, okay. Well, what did I tell you 3 weeks ago?
50% reduction or something like that, was it?
Well, I wish. I think we talked about around a 20% reduction
Yep.
or 25.
Good.
That's better news. Okay.
Yeah, very good.
And then something else that it's kind of been a Meredith and Tim project for the last year is that your flood zone changed about a year and a half ago. And so we didn't bother you guys with it. We ordered an elevation certificate. Typically speaking, we'd say, hey, listen, we need you guys we want to order an elevation certificate, and it's X number of dollars. Okay. But we said it could be a waste. But we went ahead and ordered an elevation certificate. And last year, for example, on your flood insurance, you paid $96,000. Okay. And the renewal was going to be 101,000. But we ordered this elevation certificate, and on your flood, you can rate your flood with and without it. And with the elevation certificate, Meredith came back and found that the premium was going to go from 101 to 60. And so we didn't trust us. We sent it to Right Flood and had their underwriter to rate it, and she confirmed it. So your flood premium is going down by 36,000 from last year. And that's due to like kicking over rocks and picking up whatever we can pick up.
And that's where you can bring a lot of value, and we appreciate that because you guys are the experts and you can guide us in terms of, hey, maybe it's time to do this or time to do that or consider this. So
we very well could have ordered that elevation certificate, and you never know till you check. And if we hadn't have ordered it, we wouldn't know. And I did not want to come to you and say, pay me $750 for an elevation certificate, and it was just wasted money. So we did it. We're happy to have done it. And Meredith gets all the credit. And if she wasn't here, I would take the credit. Okay. But the beauty.
But we would know it's her that's doing it anyway.
You would probably know without me saying, Eski, you would know, wouldn't you?
Yeah.
You're not paying attention to me. You would know. But Okay, the property insurance, for example, last year you had a property value of 111,726,904. It's going to come up on the screen momentarily. Okay, and so the 718 statute requires that you insure to full replacement cost. Right there, that's perfect. So the 718 statute requires that you insure the full replacement cost. And to do that, you're required to do an appraisal every 3 years. So your appraised value went up $10 million from last year. Okay. And so you're now, the hazard insurance to be fully insured is 121,539,000. And just to kind of give you an idea of what inflation has done, I mean, we were seeing appraisals that were going up 30%. And I'm going to say it coincided with COVID, you know? And I can look back and tell you now we're looking at 121 million to insure your property insurance. Several years ago, it were 66 million. So your value has doubled. And I think that there might legitimately be people that would argue that even 121 million is not enough, is low. Okay. So if you look at that screen, it shows your total insured value on line one. What it was 2025-26 there is what you're currently insured for, and what we talked about this time last year. Then we go over column 1 and 2. It shows the total insured value is 121 million. So last year you had a 5% named storm deductible. Okay. With Arrowhead. Arrowhead was the program manager. Well, Arrowhead is offering a 5% calendar year deductible, which is a better deductible. Calendar year hurricane deductible. It's calendar year hurricane, not named storm per event. Okay. Do I need to explain a little bit more what that means? Named storm is just, we have a tropical storm out there. It's named whatever. And it never gets to 73 miles an hour, 74 miles an hour, and becomes a hurricane. Then it would fall under, and it spawned off tornadoes and what have you. And we had a storm that hit here, we'd be subject to that named storm deductible. Now they've gone to a calendar year hurricane deductible. So it has to hit that threshold. So that 5% doesn't kick in until it becomes a hurricane. The second thing about that too is it's like I said, it's not a named storm, and it used to be on an occurrence basis. This is calendar year. So if we were unfortunate, we had multiple events in 1 year, you would not be forced to meet that deductible again. On an occurrence, you'd be forced to meet it again. And 5% of $121 million is $6 million. So if technically by the letter of law, we'd have to pay $6 million. If we had we had a September hurricane and then we had an early November hurricane or whatever, but now it's calendar year. Once you've met it, you've met it. Yes.
So we accumulate the loss. The first 6 million is ours.
Yes.
And then.
And another way to look at that is, let's say we had a hurricane that hit in September and we had $2.5 million in damage. We would still call the insurance company. And so we're almost halfway there. So then we have another event. You add them together. Does that make sense? Okay. So the thing that's most important to me, we've got the total insured value, the deductible, and then we got the rate, the true rate that they're charging you. Well, last year you had an 83-cent property rate. That's 83 cents per 100. Okay. Comparing apples to apples, that rate is 62 cents this year. That's a 25% reduction. So the premium, even though the values went up by $10 million, last year's premium was $925,000. Comparing apples to apples, it's $756,000 this year. Okay. As the market continues to soften, everyone, insurance companies will. A few years ago, we couldn't get a calendar year hurricane deductible. All we could get was an occurrence. And we couldn't get a 3% or a 2% deductible. All we could get was a 5. Well, now they're offering you a 3% deductible, and that premium is $871,582. Okay, so it's and the savings, that's 13% less than last year. I just show you that to show you that it is available. And if you choose to go that route, we're with you on that. That's 13% reduction compared to a 25% reduction. So I did a little digging.
So Tim, just so I understand, the second and third column, really the difference is that 3% deductible versus the 5%. But we already have a better deductible, regardless of 3 or 5, because it's on a calendar year as opposed to an event-based deductible.
And it's a hurricane deductible as well.
And the hurricane.
Yes.
So now what these two columns suggest is that if we wanted to reduce the level of deductible, then it would give us.
If you wanted to reduce,
what does it give us at the end?
Well, at the end, the premium will be $871,000 in premium. But with that being said, we're talking about it's 2.4 million that exposure you no longer have if you chose the 3. Okay. You would not be going back to your unit owners asking for $6 million. It would be 2.4 million less.
What are the chances that you're going to hit a 6 million?
I agree.
3.5 million in damages.
Yeah. And so in all probability, if I was going to say what I would say, even though I think it's a good price at the 3%, I'm going to have a sneaky suspicion that you're going to take the savings, realize the savings, and we're going to bet that the wind doesn't blow. Okay. If I was
This isn't wind though, you're talking about hurricane.
Yeah, well, I call it wind.
There's a difference between a named storm and a storm and a named storm.
Yes.
So if we had other damage that is not named, but it's wind event.
Or a tornado, say a tornado.
$25,000 is the deductible for an all other wind. Okay, 25,000. And that's down from 100,000 last year. Last year was 100,000 all other wind that wasn't the named storm. So in every facet,
I'll let you finish what you're going to say.
In every facet, it's no longer a named storm. It's a hurricane deductible. It's no longer an occurrence deductible. It is a calendar year deductible. And then the all other wind, just a tornado that happens out there. Last year was $100,000. Now it's $25,000. And I like to look back, and you had a question before you lose your thought.
Yeah, so now that this is going on a hurricane deductible and not a named storm deductible, does that mean in the event of a loss during a tropical storm, we'd be covered under the all other pearls?
If it was a tropical storm, which means it never reached a sustained wind of 74 miles an hour, then you would only be subject to the $25,000 deductible. Okay? That's the beauty of this. Is that you're not subject to the bigger deductible. Okay? That makes sense?
Yeah.
Okay.
Now, can I ask a more basic question?
Sure.
How I mean, the biggest issue is that the appraised value went up 25%.
Well, went up 10%. 10%.
And what you said in the last few years, it's gone up 50%.
Yeah, well, no.
Value based on, is it based on the sale value or building?
It's building value, ma'am.
And what construction cost and what has caused? I was looking at the details you sent us, and you said labor cost was one of the main drivers.
Well, it's inflation in general. Okay. Yeah. If I went to Home Depot today, I would have a cost. I can tell you pre-COVID, we would do an appraisal every 3 years, and the values would go up 6 to 7% every 3 years. Okay. Then we hit basically everything stopped. So we saw appraisals going up instead of 6 to 7%, we saw them going up 25 to 30% over 3 years, basically 10% a year. Okay. So now we've seen inflation back down. It's not quite as low as it was pre-COVID. So now it's going up. If I did this by year, it's gone up 3.3% a year, opposed to 10% a year, but still not quite settled down to the 2.5 or 2% a year.
This is 3 year, the differences.
Yes, ma'am. I mean, if you did an appraisal every year, you know, and some companies do that for you. They put what's called an inflation guard in. They bump you 2 to 3% every year. If that's what I would look at. Okay. But I do want to spend just a minute talking about historical and where we've been. Okay. And so with that being said, we at one point or 3 years ago, our premium went down 18%. Last year it went down 21%. This year it's gone, the rate, not the premium, excuse me. The rate went down 18% in 2024. In 2025, it went down 21%. And this year it's going down 25%. Okay. I still think after looking at what your rate, so your rate's still 62 cents. But if I told you, I could go back to 2017 and I can tell you that your rate in 2017 was 39 cents. 39 cents. Okay. And this is a cycle, guys. This is a cycle. The only thing that's going to interrupt this cycle is a Cat 2 or Cat 3 hurricane making landfall in Miami, Fort Lauderdale, Boca Raton, someplace like that. Okay. Something that's heavily populated. We're going to see the rates continue to go down. I would say next year, I think that you're going to see the rate reduction start to ease off. I would say that if I was just rubbing my crystal ball, I would say you're going to see a 15% rate reduction next year. Okay. So then that 62-cent rate is going to be down close to 50 cents. Okay. And then you're going to see probably a 10% rate reduction. You know, maybe we never get back to that 39-cent rate, but we're going to get, what I'm trying to say is that I expect to see it taper off from history, but we are going to see more rate reduction. Make sense? And at some point, insurance companies will come to us and say, we have to charge X amount of money. So here, we're going to give you a 7% reduction, and here's a 2% deductible. We're going to be able to have our cake and eat it too, because I have seen a point in the market where the difference in the deductible from 5 to 3 to 2 was virtually nothing. It was virtually nothing. The insurance company says we have to charge X amount for a rate. So it's heading in the right direction. We did go to market. Is this in what you sent him?
Yeah, it was separate.
It's a separate attachment. This is our market analysis of everyone we went to. But I can tell you in reality, there's about 3 or 4 companies on here that are real players for somebody that's 100 million plus. You can pull it up. There's about 3 companies that can really compete with Arrowhead on their program. Catalytic, it's not even Catalytic, it's Dual, Arch. There's a couple of programs out there that can do that. The rest of our insurance is, I've already talked about the flood insurance. The general liability, you're going to see basically the same pricing on the general liability that we saw in the past. You are going to see the directors and officers is going to go up. The D&O and umbrellas are going to go up some. Anything that has the word liability on it.
Is that market wide or is
that's South Florida.
Playa del Sol special?
No, that's South Florida. That's South Florida. People in South Florida love to sue. 77% of all insurance lawsuits are filed in one state. That's Florida. Think the entire country. We get 8% of the premium, but we get 77% of the lawsuits. And I know that's factual. That came from Insurance Journal. Okay. So you're going to see liability rates creep up still, but the property dealing with wind is going to continue to go down. So a 25% reduction is very good, I think. An option to have a 3% deductible is nice to have an option if you so chose that you wanted to look at those reducing exposures. The legal defense policy, as you see, it went up $500 because I think you guys have found good utilization out of the legal defense policy. Mm-hmm. It's been I don't want to use the word a lifesaver, but it's probably saved you a ton of money than what you would have had. So it's a good thing that you bought it. I would recommend that you continue to buy it. The flood insurance we've talked about, it's going down, $40,000 from last year, or $44,000 from last year. Glass policy remains the same. The crime coverage is the same price as last year. The D&O has gone from 12 to 18 because we do have one open D&O claim. Yeah. We do have one open D&O claim. We have gone to several other markets. It's good pricing. The GL is 61 to 63. We still have some other companies that may come in and look at it, but I'm telling you, this is about where it's going to end up. The equipment breakdown went up because your values went up. Your values went up. You went from a carrier that would write you up to a certain limit, and you've gotten too big for the carrier that wrote your equipment breakdown last year.
What do you think? I'll get
Tim, are we staying with Arrowhead for the property and the GL?
Yes, the property, yes. You're staying with Arrowhead on the property. No one was, I would say that they're probably 20% less than what the next closest indication we got on the property.
That's a layered policy again, right?
It is not a layered program, but it does have multiple carriers. Okay. A layered program means this carrier takes the first $5 million and $10 million. No, this is going to be like 3 or 4 carriers that take 20%, 30%, but they take it from ground up. Does that make sense? It's not like one carrier takes the first $5 million. That's okay. A legitimate layered program. When you get in a really hard market, that's when you see layered, where an insurance company says, I don't want to risk that much money. Okay. That's where we're at. Is there some tweaking and stuff? Possibly. I think this is a pretty good indication. We pushed Arrowhead really hard. We pushed the general liabilities hard, saying, hey, I know it's just outside of 30 days before the renewal, but give us some sound, hard numbers to come in and present to these people. Because I know the finance and insurance committee have to talk about it, then you have to make a recommendation. It's not something that we wanted to put you in the 11th hour.
Tim, it seems to me like we have to decide whether we want the 3% deductible or 5%. What are other buildings similar to ours doing?
It's a flip of the coin. I would say I am presenting a 3 and 5 on every account. And I would say that 60% are staying maybe a little bit more. 2 out of 3 are staying with the 5%. 1 out of 3 is going to the 3%. From my perspective, from an insurance, since I don't have to pay your bill, okay? It's easy for me to spend your money, okay? My recommendation is buy the 3%. But you guys have had, the lady you were just talking about, all the projects that you guys have going. Another thing that you're doing that's going to help your insurance program next year is about the first of the year is when we expect to have the new roof on, right? Mm-hmm. Okay, I mean, that's gonna be a tremendous bargaining power because your current roof is 20 plus years old. So when an insurance company goes in and models this, a 2026 or 27 roof models much better than a 2006 roof. Okay.
Can you endorse the policy once? No. So
no, we're kind of stuck. Citizens is the only company. What we would do, Citizens is the only company that I know of that will once you get the roof done, the permit's closed, you get a new wind mitt, and the wind mitt shows the permit. Then you send it to citizens, and citizens will endorse the policy that day. Basically, insurance companies say, once you're in hurricane season, we're stuck. Let's say you got the roof. If you were going to have the roof done, your renewal's 5/31. Let's say that you were going to have the roof done 1st of July. I think I could have pushed the insurance company to give us about another 7 to 10% reduction. What I literally would have to do would go to the roofer. I would need a project report, a timeline report, and I would literally have to come out and take pictures to show they actually were working on your roof, showing, okay, here we are, May 1, basically, and we're 30% done with the roof. And I can show you that, in the next 2 weeks, and ever how long it takes to get it done. You know what I mean? Then I think that in all probability, we could have pushed the carrier if timing was on our side. We could have pushed, you could have seen probably another $70,000 to $80,000 reduction in premium, maybe as much as 10% with the.
So I know that in the residential side of the market that you need 5+ years on your roofs now when we're doing the wind mitt. And so otherwise, they're going to say no, go to citizens. That's kind of what way they're rolling right now. Because you just said that, it just made me wonder on your policies, when you write your policies, on other guidelines for the building in terms of mechanicals and outside. So we're looking at doing a new Sears and non-Sears, and we could have a company say, well, you got 25, 30 years on this, but you're seeing your premium's going to go up after the 20-year point. So how do we balance that out as a finance committee?
Well, that's a great question. And the insurance company has data. You have a flat membrane roof. The insurance industry says historically in South Florida, flat membrane roofs last about 15 years. Okay. We have rain every day in the summer. And I bet this new roof you're putting on, it's probably going to have some pitch to it, opposed to the old roof you had on, where you had more, and pardon my Kentucky accent, pooling, where water would stack in the middle, and then sun would come out and it would microwave it. Okay. Now they're making you put a roof that drains better. So that's going to make roofs last longer. So as that data continues to go in, maybe the insurance company goes from saying 15 years to 17 years, something like that. But because you guys, if you guys take care of this roof, then we can stretch the 15 to 20. Okay.
Is that based upon claims?
It could be based upon claims, but you said the 5-year thing. That's a magic number in insurance.
I know. And so that's why I'm saying.
It's a magic number.
Because we look at, the dream list. So the Sears and the non-Sears, they give us a flat number. And I'm like, whoa, wait a minute, because the industry, I know from my industry, it doesn't work like that. And so, you basically look at your electric, your roof, your plumbing, there's all these functions. You must have that kind of a list.
Oh, yeah.
So if you could give us your list so that we can look at it against the new list we're going to get, then we can balance.
One of the things that we've done is communicated with your carrier. You guys have been planning to put on a new roof for 3 years. Okay. No, but you had the roof was the last thing because it made sense because you were stacking material on your roof. So who wants to put a new roof on and then we go up there and tear the roof up? Okay. So it just makes perfect sense that you had your elevator repairs and all those other things. So we've communicated, say, okay, yes, this roof is this age. And yes, they have already passed an assessment and have already collected the monies for this new roof, but it's not going to go on until we have the elevator done, until we have all the other things, because why go up there and how much is the roof costing?
1.6.
Why go up there and tear $1.5 million roof up? Okay. So
understand.
back to the 5 years.
That just got me to thinking, well, if you have this number of years, that they start like discounting or taking away your discounts, then I'd like to know the other systems they do it
Is
on.
there anything else we can do?
They model it,
earlier?
okay, and it's based upon characteristics. The model is computerized, it has no human
It's
aspect.
different from the model we're seeing in the Sears and not Sears.
Yes. But
What
let
we
me,
did do in the past, there was no preventive maintenance done on it. We keep up with preventive maintenance.
Oh,
ensuring-
you just took words right out of my mouth right there.
That's the key.
That you can see.
Being proactive is if again, it's easy for me to spend your money. Okay. But if I could give a wish list to you that you would have an annual inspection done on your roof, and that after the inspection, the roofing inspector is going to come back with maybe some type of recommendation, and then you're going to comply with the recommendation. You're going to maintain your roof. Or if I can show an underwriter that goes a long way. But I want to go back to the 5 years.
Sometimes it does, and sometimes it just depends.
Well,
Yeah.
in my industry, here's what it depends more upon. Are we in a hard market where rates are going up? Are we in a soft market when rates are going down? Since we're in a soft market, the underwriting guidelines, ma'am, they don't change. They just waive them. Okay. If we're in a hard market, they go back in to enforce it. But let me finish on the point you made, the 5 years. An insurance company says they don't want to be on something they want 5+ years. Okay, if we have a roof inspector come out and he says you have 2 to 3 years of life expectancy, that's subjective. An insurance company says that's a claim waiting to happen. So we don't want to be on that risk. So what we want to see is that roof inspector. So when you do that roof inspection, that annual maintenance thing, that's the next thing we want him to add to that inspection to say what type of life expectancy. Because I've seen new roofs that after 5 years are shot. It's not maintained. So if after 2 or 3 years you're doing these inspections, you've got this report out there that says it should last 25 years, but that's taking a lot of assumptions.
And what Bill said was, very true. And it's all about that preventative maintenance, which we have a new engineer, which is all into that. And, he's got his book of preventative and yearly. So we're really getting now ahead of ourselves, which is great. And, but, which made me think, if there was a guideline, because I knew that 5 year and I knew what you were going to say, but, I'm just one person. So in a huge building here, but, the other things, we have cooling towers, we have electrical, we have other, systems that
there's a lot of maintenance that have to go on.
They rate us on,
Yeah.
right?
Yes.
So, let's say if we have an electrical fire, they're going to ask us, well, when was the last time you had this and this done, right? So we must have something
Sure.
that we can do. So if you could give that to us.
We'd be happy to. Any data that we can provide, we're happy to do. The maintenance, that maintenance thing is fantastic. Is that it's something that that's the eyes and ears of the underwriter. He sees that you're being proactive. And let me tell you, if you do that, you're in the top 20%. So 80% of the people don't do that. So an underwriter has the ability to give what they call judgment credit. And so you're going to, if they have a maintenance program, I have a copy of it. I can give it an extra % off because these people are going above and beyond. Okay.
Tim, additionally, this year we hired a building engineer, so we have a specialist that's just in charge of maintaining our building. Not a worker. We have an engineer that's out there monitoring the conditions of every single building system.
He started from zero.
And I was just going to add to what Heskey said. So we're making some investment spending, brought that engineer on board. He's producing a manual to document all the different systems we have, what their condition is, and to do some preventive maintenance on them. So as we get more clarity on that, as we get more definition, we'd like to engage you guys and say, hey, how can we
And we would
how can we leverage that to our benefit and towards the insurance companies? The other thing I wanted to ask was, do the sprinkler systems impact these insurance premiums at all, or
sure.
not?
If the building was fully sprinklered, you would get, okay, of your property premium, let's just take $1 million. I would say 800, 1,000 of that would be wind. Okay. Then 200,000 would be what we call all other peril or X wind. So then the next biggest hazard that you have besides wind is fire. Okay. So 20% of your rate is 20% of your premium is based on that. So if you had if a building was fully sprinklered, you'd probably see a 10 or 50 or excuse me, a 25 to 30% discount on that portion.
Once we put those in, which are going in this year.
Yeah.
Yeah, and that's going to.
Oh, well, the next thing we would do, we would call ISO, Insurance Service Office. We'd have them to come out and do an inspection, and they would publish a fire rate, literally a fire rate for your building that every insurance company can use.
Also getting a new BDA radio system, so that's already in the works. So
I bet you this is a finance/insurance committee, or
yes.
So when you get done with this roof, you're probably going to start budgeting for your next roof, right? But if by doing this proactive approach that this engineer is going to help you with and all this, if we could stretch that new roof out an extra 3 to 5 years, that's going to give you a ton of relief to your unit owners.
So Tim and Meredith, I suggest we have a session before we embark on the budget process and bring you guys up to speed on some of the preventive initiatives we'll be doing over the next 3 to 6 months, and meet again in September, October, and say, hey guys, how can we leverage this for maybe some of the things that have been executed or completed, but also heading into the next year's budget for or next year's premium.
Mike, I would like to go a step further than that. I'd like to know what your short-term objectives are. I want to know what your medium-term objectives and what your long-term objectives. If we know that you're
once we figure them out, we'll let you know. But
okay.
Yeah, absolutely.
But any of that information we get, we just share it with the insurance company, that they know that you're on the ball, that you're in the top 5% of maintaining your building. Okay. You guys are in the top of the top. I mean, we see a lot of associations. I see a lot of people that have to pinch pennies, have to cut this, cut that. But you've got a beautiful building here, and you've put a ton of money in it to maintain it, and built in 73, 75. So we've got a 50-year-old building that every now and then needs a facelift. I mean, it's kind of like my body, is that yeah. I mean,
So Tim, I have a question. 3 years ago when I was on the board, I was sitting next to you at the board meeting, and I turned around and I asked you how our building rates amongst all your other buildings with respect to lawsuits. And at that time, you told me that we were at the top, and that
not the good top,
not the good top, and that we should watch ourselves, meaning we shouldn't, we should be lawsuit adverse. And so, 3 years moving forward now, how would you look at our building? I
would say that in the last 2 years, you have vastly improved. Vastly improved. It is. We were at a point 3 to 5 years ago that we were always going to be able to get you insurance, but you were going to be costing yourself your general liability premium, your director's law. Instead of your general liability premium being $60,000, it could have easily been $120. Could have been double. It could have been double. And instead of having $1,000 deductible as you have now, it could have been a $10,000 or $15,000.
I think the message came through loud and clear. When I asked the question, I had no idea how you were going to answer me. And because I just got off the board, I was on 3 years. And so I was always like, oh my God, it's like, this is what Tim told us, because I was always worried about that.
Well, I was painfully honest, wasn't I?
Yes, well, that was good though. So yeah. I don't mind painfully honest, but, can I ask you a question about gap insurance for a single homeowner for this building? So based upon what you're saying, because I'm looking at the risk, there's a $6 million risk here. So, we divided by 370,000 units, 370 units, we should have gap insurance for that amount. Is that correct?
That would be something that you would, okay, if everyone had a homeowner's policy, okay, there is an assessment provision built in your homeowner's policy. If there's an insurance claim, you can turn a claim in under your homeowner's policy. One of the cheapest ways to do that is to call whoever your homeowner's carrier is, and by law they have to offer you $2,000. Okay, but there's many carriers that will let you increase that loss assessment limit from 2,000 to 5,000 and more.
Oh yeah, I had gap insurance when we had all the storms in 2005, and it really paid for itself. And so it was great to get that money back. So, and that's something that I always think about, for the homeowners, because we don't talk about insurance with them. And I always think that we should, because it should be mandatory that they carry insurance, and we should at least inform them about the gap, right? And so I really, even before you, I was preaching to the choir. So, it's the people don't understand. It's windstorms, not only like your interior, but you have to have windstorm insurance, and there's different carriers. And, I wondered about that, and because I have, my own general liability and policy and things like that.
What we're going to see if the wind doesn't blow is more carriers are going to come into the state. Okay. And when a new carrier comes in, the very first thing that they're going to want to do, they want to write the brand new buildings. Okay. They're going to want to write the 2020 and newer buildings, but that creates capacity for those other companies. So it's supply and demand. That's what it boils down to. So it's in supply and demand. We're going to see if the wind doesn't blow, more carriers come in. That's going to put more pressure on the market. And Meredith and I had this discussion on the way up here. Is that there's your rate got down to 38, 39 cents way back when. And I'm not so sure that we were better off it getting that low, because when they pulled the rug out from underneath us, it went up too drastically. It was like a stock market reaction.
I got a question, Tim. On the second page here, what's the separation between building and contents?
If I could take this building and turn it upside down and shake it, if it fell out, it's contents.
Furniture.
Yeah. Literally.
I mean, so
Common areas, the floor covering, wall covering, ceiling covering, cabinets, anything in common areas is considered part of the building. It's considered that's in common area. Okay.
I mean, mechanical equipment, that's
Mechanical equipment,
contents, cooling tower on the roof.
that would be contents. Yes. That would be contents. Yeah. Well, yes.
I mean, it was covered under the equipment breakdown.
It's under
I mean, hurricane wise.
Yeah, hurricane wise it's permanently attached to the building. So let me back up and say that's part of the building. It's permanently attached. It's not something that you can just take away.
Yeah.
Carpet's part of the building. That's part of the building. That's
Okay,
building.
so
In the
sometimes it's just furniture, the stuff we can walk away with.
yes,
So, okay.
on the common areas. When we get to a unit,
No, yeah.
you have your own insurance, right? Yes.
A certain amount that the building picks up if there's water intrusion.
Right.
So there's kind of a balance there between homeowners and the
Basically, the association's master policy
Building of,
drywall. Drywall.
okay,
yeah, we're responsible for drywall.
is kind of another way to look at it is basically the master insurance policies, which is what we're talking about right now, is a shell. Okay, it's got the drywall up. Let's say I come in, this is mid-construction, I want to buy this unit, and the developer says, okay, the floor covering hasn't come down, hasn't been put on. We've got concrete floors, we've got drywall up. We'll give you an allotment for this, this, and this. That's covered under the homeowner's policy. If you want to upgrade your cabinets, things like that, it's covered under the homeowner's policy, the HO6. Did I say that right, Meredith?
very good information. Thank you, Tim and Meredith. Are there any other questions or comments? Because we're way over time, but
I'm sorry. I always do that.
no, it wasn't. It was very useful and we appreciate it. And like we said, we're gonna engage again. Well, the priority in the next month is to firm up and finalize these individual elements, insurance elements, and renew our policies. And then come fall, we'll definitely engage you and Meredith into sharing information so that we can, help
Plan for the future.
plan for the future to have even lower fees. And, we appreciate the fact that you give us feedback and insight and that we are, one of the top buildings and we want to maintain that. And we're doing things to continue in that regard. So we're pretty excited about some of the investment spending we're making and the preventive maintenance programs we're putting in place. And we think we should get benefit for that. So.
I agree with you 100%.
All right. So the thing we have to decide, and maybe Heskey, you can chime in on this, is how we go forward and decide on the deductible level.
We'll put it on the agenda for this month's board meeting.
Okay, great.
When is the board meeting? That way we just kind of get a timeline because we have a 5/31 effective date. So your next
Yeah.
board.
So it's
32.
probably gonna be on the 19th.
So we will have 100% within the next week. We'll send you another copy of this proposal. And these numbers are golden right now. The only thing that could happen is that and I'm going to use the word slightly improve, okay? Is that this is what we have today. If somebody comes in with a little bit better general liability or something like that, I don't think I'm going to get a better property quote, as you know, we insure a lot of associations and a 62-cent rate is not something that I haven't sold any other 62-cent rates. How about that? It's the lowest rate that I've brought out.
Would we be able to get everything for the 21st, the financing agreement?
Oh, by
have
the end of
one
next
ready.
week, by the end of next week, for certain, we would be able to give you everything.
All right.
Everything.
That way we can just approve everything at the board meeting.
Yeah. And I know in the past, you guys have put different amounts down because it's less finance, so if you guys can give us some feedback on
Just 12 equal payments.
that's what you want to do.
The interest rate right
Yeah.
now on financing.
And then, Mike, maybe the finance committee can make a recommendation to the board.
It should be.
Yeah, we can have a quick call on this. So once we get the information, we'll circle around the finance committee meeting, finance and insurance committee meeting, and then we'll provide you that information, Husky, and you can share it with the board.
Just be
Let's think about it to the members. Let's start thinking about it and
Mike
we'll
and
exchange
Heskey.
information. The other thing, Tim and Meredith, I've received written questions from owners related to insurance. A lot of them are for clarification purposes and for information. Can I send you an email and you can address those? And I don't think they'll have any impact on the rates or the process we're going through, but it's more for information purposes.
Yeah,
If you can get back to me and then we'll publish those.
Yep.
That's easy.
Do you guys
So
have
I'll send it to you, Meredith, and I'll copy you, Tim.
for
appreciate it.
homeowners, like
All right, great.
providing homeowners on this building? Do you
Oh, yeah.
guys have, or Barbara, you?
We don't do homeowners, but I can give you names of agents that specialize. Sometimes I'm not as successful as I want to be.
They're Tri-County area, but they're pretty good. They have they got the really good policy. And like I said, all my high net worth people go to them. So and they change them around, just depends on what level you want to insure yourself at. And they move things around, but also a couple of names would be great. I just use Nissia because they've been around for a long time.
Well,
And
it's a trust issue.
yeah,
It's a
they've been
comfort and
around for
trust
over
issue.
35 years. They have an office right here in Oakland Park now.
Anytime any of you guys need any personal help with something like that, if you want me to look at your homeowner's policy, I'm happy to give you my opinion on it. Yeah, I'm happy to do that. And we'll go from there. Okay?
All
Great
right.
stuff. Thank you.
Thanks, Meredith.
Yeah.
Thank you.
Thank you, Sandra.
We're,
Thank
we're
you,
saying that there's a
Tina.
possibility
Thank you,
of us
Mike.
getting like a
Thank you, Barbara.
7 and 10% discount
On the roof.
because of the roof. Next year, would that be on top of the already 10-15% you're thinking?
Yeah, I would think that, I think that, let's say, let me put it like this. Let's say the average market decrease next year is 12.5%. I could see it pushing your discount to 20. Is that fairly answered? Is it? Yes, it's on top of. Having a new roof is definitely gonna, if you got a 15% reduction next year, that rate would be around 50 cents. So if you got a new roof, you might be able to push that with having that new roof, we might be able to push that rate down to 45 cents. But it definitely will help. Yeah. Yes.
Expensive for you.
Pardon?
I was talking to Scott. The other.
Brooke, you have a question?
Yeah, Scott, given it sounds like you're going to take some action here pretty quick with the board meeting, do you think you can post this video sooner than 30 days out?
Yeah.
Great. Also, does the insurance guy have any thoughts on alternative lodging expense companies? How long do they typically, would I be able to find an insurance that would give me ALE for like 2 years? Alternative lodging expense?
In your homeowner's policy, there's a portion of your additional living expense is what they call it. If you had to, because due to a claim, you had to vacate your unit, your home, then they allocate X amount. But every company's different. So it's called additional living expense. So if you had to move into a hotel, rent a house, do something like that, due to a fire loss for 6-8 months, then yes, that's built into your homeowner's policy.
Okay, maybe I can try to figure out what your contact information is, because I would like to see if I could find one that would hold up to 2 years. I just don't know if the market would allow that much.
Since that's not my expertise, I would be giving an educated guess. I'm happy to find out some information, and I'll email you back. I'll just send an email back. Hey, I did some research, and here's the parameters on additional living that your typical homeowner's policy provides, and here's the options within increasing it. I can do that.
That'd be great. Why don't you just funnel that through Mike? That way all communication, there's no issue with what I said or didn't say.
Okay.
Thank you.
I think I can do that one. Okay.
Okay. Thank you, Scott, and hopefully you can get the board meeting and this meeting up on Building Links soon.
We appreciate
right,
you letting us come out.
Okay, well, this meeting comes to a close. So I thank you so much, Tim and Meredith, for joining us and providing that insight. And to all the participants and the Finance Committee members, thank you so much for the work you've done. I think we're certainly headed in the right direction. A lot of collaboration, a lot of things that we can provide support and input towards. So thank you, and have a good afternoon.
Thank you all. Thank you for letting us come out.
Thank you,
Good to
guys.
see you all. You again. Thanks.
Bye.
Thanks, guys. Thank you.
Yeah.